Assalamualaikum warahmatullahi wabarakatuh. We are from Group 2. In this occasion, we're going to discuss about consolidated financial statement based on the PSAK 15, 22, and 65, and separate financial report based on the PSAK 4. Our group consists of 2 persons. My name is Nandini Pramadani, and my partner Nisrina Afifah. So I'm gonna begin this presentation. It's about the PSAK 15. It is the investment in the entity, association, and joint venture. This PSAK 15 is applied by all entities that are investors with a joint control or significant influence over the investee. For example, I took consolidated financial statement from PT Bukit Darmo Property, TBK, and the subsidiary, and it is stated that they use the PSAK number 15. Next is the significant influence. This is the power to participate in the financial and operational policies, but does not control over these policies. If the company, the voting rights is bigger than 20% in the quantitative indication, it will be considered to have a significant influence. If it is less, it is considered to have no significant effect. This is the example in this company. The ownership is more than 20%, so it means that they have a significant influence. And the second one is qualitative indication. It is the representation of the board of directors and commissioners or equivalent organs, and the participation in the policy-making process, including the dividends and other distribution, and the material investor transaction with the investee, and exchange of managerial personnel, and provision of the basic technical information. And this is the statement in this company. They said that it can be issued. It is approved to be published by the director. And in the significant influence is considered the potential for voting right. Next is equity method. And this PSAK also have equity method. It is increase or decrease to recognize the share of the investee's profit or loss after the date of the acquisition. And it will be recognized also, the investee comprehensive income will be recognized as a comprehensive income, and the investment increases in the investor bookkeeping. And the last one is if the distribution of the investee reduces the carrying amount of the investment. And in here, the potential for the rise will do not affect the investor share profit. Next is the equity method procedure. Adjustment for the share of profit and other comprehensive income, and the gains on upstream and downstream transaction must be eliminated. Upstream will be eliminated completely, but downstream is eliminated as its share. Downstream is, for example, selling the asset from the association entity to the investor. And the difference between the acquisition cost and the fair value of the net asset, it will be called goodwill. And adjustment of the entity's value for the profit or loss of the associate or joint venture after the acquisition is made for impairment loss recognized by the associated entity. This is the investee financial statement. The financial statement will be available. Associate and joint ventures are used to apply the equity method, and if it is different, then they have to make the financial statement with the same period. And if the reporting dates are different, the adjustments are made to the significant transaction and event that occur between the investee and the investor. But supposed to be a concern that the difference should not be more than, say, 3 months, and the length of the reporting period is same. And last is the investor financial statement are prepared using uniform accounting policies for transactions and events in similar circumstances. And this is investee losses and impairment losses. If the investor shares losses of associate equals or exceed the carrying amount of the investment will be reported as zero. Losses are reserved and a liability is recognized when the investor has a constructive or legal obligation to pay the obligation of the associate company they guarantee. And for the impairment loss, indication of impairment using the provision of financial instrument that will be discussed in PSAK 55, and impairment of investment value it will be tested under PSAK 48 as a single asset, and the impairment of loss, impairment of investment is the difference is between the carrying amount and the recoverable amount, and the recoverable amount is the highest fair value less the cost to sell and the value in use. Next is discontinuation of the equity method. Why equity method will be discontinued if the entities become a subsidiary, and if the remaining interest is a financial asset, and if the fair value of remaining interest is treated as a fair value when the financial asset is initially recognized in accordance with PSAK 55. And this is two conditions. When the equity method is discontinued, all amount recognized in other comprehensive income are on the same basis if the investee dispose. So it will be same basis used. And if the investee becomes an investment in a joint venture or vice versa, the entity continues to apply the equity method and does not remeasure the remaining interest. In the PT Bukit Darmo property, the total profit or loss if there's continuation of equity. Next is PSAK 22 about the business combination. Business combination identification. The business combination is a transaction or other event in which an acquirer obtains control over the one or more business. It can be the true merger or merger of equals. The scope is for any company except for UCC, joint venture, and acquisition of asset. And this is all about the acquisition recording method. The acquisition cost will be charged during the current period, and the asset and liability measurement following other PSAK. And the acquisition is gradual because it will be measured again. The difference is recognized as profit or loss. The control based on the fair value, and the goodwill entities is about the impairment, and negative goodwill is about profit or loss. The control in the PSAK 4, when the parent entities own directly or indirectly through subsidiary more than half of the voting power of an entity, except it can be clearly demonstrated that ownership is not accompanied by control. Actually, it will be discussed later by my friends, but it is only the board view of this control. The investor control an investee when the investor is exposed to or has the right to variable returns from their involvement with the investee and has the ability to influence those returns through his power over the investee. The investor control the investee if and only when the investor owns all of the following, like the power, the exposure or right, or the ability to use its power over the investee. If they don't want to use their power, so it can't. And next is in this business combination, there are acquisition method, which is an entity accounts for any business combination using the acquisition method, and the acquisition identification, it is determination of the date of the acquisition, recognition of the measurement or identifiable asset, liability, assumed and non-controlling interest, and the recognition and measurement of the goodwill or gain from discounted purchases. And the acquirer in this business combination is one of the combining entities. It is identified as acquirer, the entity that gains control over the acquiree. Acknowledgement provision. At the acquisition date, the acquirer supposed to recognize separately from goodwill the identifiable asset acquired, liability assumed, and the acquiree's non-controlling interest. In this acknowledgement, in this provision, they must meet the definition of the asset liabilities in accordance with the KDPPLK at the date of acquisition. It is the part of the exchange between the acquirer and the acquiree in a business combination transaction, but not the result of a separate transaction. Allows the emergence of the asset liability not previously recognized by the acquiree, and classifying or determining identifiable asset acquired and liabilities assumed as required to apply under Indonesian GAAP, and make the classification based on the contractual terms, economic condition, operating or accounting policies, and other related conditions existing at the date of the acquisition. Exception for the operating lease contract and insurance contract given the condition of the contract at the acquisition date. Transferable benefit. It is measured at the fair value, the sum of all assets transferred by acquirer, liabilities recognized by the acquirer, and equity interest issued by the acquirer. And there is employees reward, and the carrying value of the consideration transferred is measured at the fair value, the gain and losses at the acquisition date. For the contingent rewards, it is arise because of the agreement, and it's recognized contingent consideration at the fair value at the date of the acquisition. And if the profit of the acquired company in the first 2 years increased by more than 10%, an additional payment of 10% will be given from the increase in the profit if more than 10%. And the acquiree is granted share option with a certain value related to performance. Business combination without transfer, the control can be obtained without transfer of the benefit, including if the acquiree buybacks its shares so that the acquirer gains the control, and the loss of the veto that prevents the acquirer from controlling, and the acquirer and the acquiree agree to combine their business with the contract only. Recognition in accordance with PSAK give rise to dominant or wholly non-controlling interest. Next is indemnification asset. The seller guarantees the acquirer the uncertainty of contingencies or certain asset and liability, and an acquirer obtains an identified asset at the same time as it recognizes the guaranteed item and is measured on the same basis. And at the end of each period, an acquirer measures identified asset on the same basis as guaranteed asset or liability. And recognition is terminated or if the acquirer takes asset, sell, or lose a right. Accounting measurement after initial recognition. In general, the acquirer measures and records the asset acquired, and liability assumed or incurred, and equity instrument issued in a business combination in accordance with the PSAK for this item, depending on their nature. And the special guidance on this accounting measurement is reclaimed rights, contingent liabilities recognized at the acquisition date, and asset indemnification and contingent consideration. And the reclaimed rights, it is recognized as an intangible asset and amortized over the remainder of the contractual period underlying the contract. And if the carrying amount is the basis for the determining the gain and losses if sold. An acquirer discloses information that enables user of financial statement to evaluate the nature and the financial impact of the business combination that occurs during the reporting period or after the end of the reporting period, but before the financial statement completion date. And An acquirer discloses information that enables user of financial statement to evaluate the financial impact of adjustment recognized in the current reporting period relating to the business combination that occurred in that period or in the previous reporting period. If the specific disclosure required does not achieve the disclosure object, the acquirer will disclose all additional information needed to achieve the objective. So this is the illustration of business combination. For example, Pearl Company bought 80% of Simbao Corporation on January, and for 8,000 shares at the price of 10 per shares, nominal value 5 share per share. Total net asset value of Simba on the acquisition date is 80,000. Based on a per share value, the asset of the Simba Corporation were evaluated with an increase of 10,000 after the acquisition. 400 consultant and accountant were incurred for the acquisition. The stock acquisition registration fee for 2,000. And the journal of the acquisition of Simba Corporation like this: investment, acquisition cost, share capital, additional share capital, cash, and draw, and investment value. This is and the book value, the amount purchase, goodwill parent, total goodwill. The parent company acquired 80% subsidiary. The assets subnet for the acquisition of 120,000, 1 million, and 20% on consolidated book value, accounting subsidiaries, and this is the information: current asset for 2 million, non-current asset of parent, and this is the subsidiary one, and the liability and equity. And then for the goodwill, parent goodwill is 160,000, and this is the consolidated financial statement. Current asset, goodwill, and non-controllable.
My name is Nisrina Afifa, and I'm going to explain about PSAK 65 and PSAK 4. Now I'm going to start with PSAK 65. The standard aims to establish the principles for the preparation and presentation of consolidated financial statements when an entity controls one or other entities. It requires an entity that controls one or more other entities to present consolidated statements. It also defines the principles of control and establishes control as the basis for consolidation. The standard also determines how to apply the principle of control to identify whether an investor controls an investee so that the investor must consolidate the investee. It also established the accounting requirements for the preparation of consolidated financial statements, and also defines an entity and establishes exceptions for consolidating certain subsidiaries from investment entities. The definition and method of establishing the principles of control as the basis for consolidation. From paragraph 5, investor, regardless of the nature of his involvement with the entity or investee, determining whether the investor is a parent by assess whether the investor controls the investee. From paragraph 7, the investor controls the investee if and only if the investor owns all of the following: first, power over the investee; second, exposure or rights to variable returns from its involvement with the investee; and the third is the ability to use its power over the investee to influence the amount of return on the investor. Power over the investee. From paragraph 10, having power, the ability to direct the relevant activities. Paragraph 11, power arises from rights, such as own of certain amount of equity, but sometimes it requires more complex factor to be considered. And then from paragraph 12, the investor with the current ability to direct the relevant activity has power even though the right to direct has not been exercised. Explanation about yield. From paragraph 15, the investor is exposed to variable returns with an investee when the returns investors on his involvement have the potential to vary as a result of the performance investees. From paragraph 16, although only one investor can control the investee, more than one party can share the returns on the investee. For example, others of non-controlling interests may share in the profits or distributions of the investee.
Explanation about principals and agents. From paragraph 18, investors with decision-making rights determine whether the investor acts as a principal or agent. The investor, acting as an agent, doesn't control the investee when the investor exercises the decision-making rights delegated to the investor. Explanation about accounting requirements. From paragraph 19, parent entity prepares consolidated financial statements using uniform accounting policies for transactions and other events in similar circumstances. From paragraph 20, consolidation of the investee. Starting from the date the investor acquires control over the investee and end when the investor loses control of the investee. Determination of the investment entity. From paragraph 27, an investment entity is an entity that first obtaining funds from one or more investors with the aim of providing them with investment management services. Declare a commitment to investors that its business objective is to invest funds solely to obtain returns from increases in capital value, investment income, or both. Measure and evaluate the performance of all its substantial investments based on its value. Paragraph 28. Judgments in assessing whether an entity meets the definition of an investment entity. Specific characteristics of investment entities is 1. Have more than one investment. 2nd. Have more than one investor. 3rd. Has investors who are not related parties of the entity. And then has an ownership interest in the form of an equity interest or an interest similar to that of. Paragraph 30. A parent company that ceases to be an investment entity or becomes an investment entity prospectively records a change in status from the date that change in status occurs. Explanation about investment entities consolidation exception. From paragraph 31, an investment entity doesn't consolidate its subsidiaries or apply PSAK 22 about business combination when that entity acquires control over another entity. However, an investment entity measures its investment in a subsidiary at fair value through profit or loss in accordance with PSAK 55. Paragraph 33. A parent of an investment entity consolidates all its controlled entities, including entities controlled through a subsidiary that is an investment entity, unless the parent entity itself an investment entity. I'm going to explain about PSAK 4 about separate financial report. This standard aims to set out the accounting requirements for investments in subsidiaries, joint ventures, and associates when the parent entity presents separate financial statements as additional information. Separate financial statements are financial statements presented by the parent entity that record subsidiaries, associates, and joint ventures based on acquisition costs or in accordance with Article 55. Separate financial statements can only be presented as additional information in a consolidated statements. Parent entity cannot present financial statements for general purposes and at least consist of a statement of financial position, a statement of profit or loss and other comprehensive income, a statement of changes in equity, and statement of cash flows. Scope of this article. From paragraph 2, this standard applies to parent entities that present separate financial statements in recording investments in subsidiaries, joint ventures, and associates. This statement supersedes PSAK 4 year 2009, both consolidated financial statements and separate financial statements. Preparation of separate financial statements. From paragraph 5, the financial statements are prepared in accordance with applicable Indonesian GAAP. If a parent entity prepares separate financial statements for additional information, the parent entity records investment in subsidiaries, joint ventures, and associates at cost or in accordance with PSAK 55 Financial Instruments Recognition and Measurement. Parent entity applies the same accounting for each investment category. Investment carried at cost are recorded in accordance with PSAK 58 about non-current assets, held for sale and discontinued operations when the investment is classified as held for sale or is classified as held for sale. The investment measurement recorded in accordance with PSAK 55 doesn't change under these circumstances. Paragraph 7. If the parent company also has an investor or venturer chooses in accordance with PSAK 15 about investment in associates and ventures together with paragraph 17, measuring its investment in an associate or joint venture at fair value through profit or loss in accordance with PSAK 55 about financial instruments, recognition and measurement. An entity also records the investment in the same manner in its own financial statement. Paragraph 8. When the entity ceases to be an investment entity, the entity records the change from the date when that change in status occurs in accordance with paragraph 6, whether records the investment in the subsidiary at cost. The fair value of the subsidiary at the date of change in status is treated as carry-on cost at the date, or continue to record the investment in a subsidiary in accordance with PSAK 55, Financial Instruments, Recognition and Measurement. Paragraph 9. A parent entity recognizes dividends from a subsidiary, joint venture, or associate in profit or loss in separate financial statements when the rights to receive dividends are determined. Paragraph 10. When a parent company reorganizes its group structure by forming a new parent entity as a parent that meets the following criteria. The new parent obtains control of the original parent by issuing equity instruments in exchange for the original entity's equity instruments. The assets and liabilities of the new group and the original group are the same immediately before and after reorganization, and the owners of the original parent prior to reorganization had an equal and relative share of the net assets of the original group and the new group immediately before and after the reorganization. And the new parent entity records its investment in the original parent in accordance with the paragraph 6 of the separate financial statements. The new parent entity measures the cost at the carrying amount of its share of equity items in the parent entity's separate financial statements at the beginning of the acquisition. Paragraph 11. Similarly, an entity that is not a parent may establish a new entity as a parent that meets the criteria in paragraph 10. The requirements in paragraph 10 apply in the same way as for the reorganization. In that case, initial parent entity and initial group of companies revert to starting entity. PSAK 4 adopts IAS 27 Accept. Purpose of IAS 27 is to provide accounting and disclosure requirements for entities and subsidiaries, the scope of which is to present separate financial statements. Preparation of separate financial statements for public purposes. The definition. The reference to IFRS 9 financial instruments. The presentation of separate financial statements is not an addition to the consolidated statements. The exception of the parent entity not to present separate financial statements. The effective date and transitional provisions when the entity status changes.
So this is the end of our presentation. Do you have any question? Please feel free to comment below. Thank you so much for watching.